Welcome back to the Deep Dive, the place where we don't just summarize your sources, we extract the tactical insights you need to master your material. Today, we are undertaking a really critical deep dive into, well, what you could call the engine room of operational finance. We're talking about working capital management, or WCM, and we're specifically targeting the conceptual and strategic understanding you're going to need for success in the ACCA financial management exam. Now, for so many students, WCM, it just feels like a necessary evil, doesn't it? A sort of tedious collection of ratios, current ratio, quick ratio.
Yeah.
And maybe that one awkward formula, the economic order quantity, the EOQ. And that's often where people stop. They just focus on the mechanics.
They do.
But if you walk into that exam hall thinking this is purely about calculation, you are, I have to say, fundamentally underprepared. The conceptual depth here, the understanding of risk and strategy, that's what separates a pass from a high score.
That's absolutely right. And, that is exactly why we're here. Our mission today is actually pretty straightforward. We need to move your understanding far beyond just, calculating that current ratio.
Okay.
We want you to really grasp the strategic trade-offs, the critical daily risks that are inherent in managing these short-term assets and liabilities. The examiner, you see, isn't looking for a calculator operator.
Oh.
They are looking for a future financial manager. And that means you have to demonstrate a profound understanding of the implications of these daily cash decisions on the long-term health and, crucially, on the survival of the business. We're going beyond the textbook and getting right into the so what of WCM.
I think that shift in perspective is just essential. From calculation to strategy. We often talk about the financial manager's big decisions, don't we? The headline-grabbing stuff.
CapEx decisions, yeah.
Exactly. CapEx. Should we commit $500 million to a new facility? How do we fund it? Debt. Equity. And those are, of course, undeniably high-stakes decisions. But those huge long-term plans are entirely meaningless if the company runs out of cash next month because of poor WCM.
Absolutely.
WCM is the financial manager's constant, gritty, daily battle for operational survival. It deals with the short-term stuff: current assets inventory, receivables, cash and current liabilities, payables, and short-term debt. It's fundamental, keeping the doors open, the machines running, the payroll covered.
It's everything.
It's everything. It's ensuring the company survives long enough to actually realize those big long-term objectives.
To reiterate that, working capital is the lifeblood of the company. It's the engine room where those short-term cash flows live. And if there is one single most crucial point you take away from this entire deep dive, it is this. A company can be wildly profitable on paper.
Right.
It could have massive sales volumes, hugely successful product lines, huge net present values projected for its projects. But if it runs out of cash in the short term, it fails. Full stop.
That's the bottom line.
That is the bottom line. Profitability is a long-term measure of success. Liquidity is a short-term, immediate necessity for survival. And the WCM chapter explains exactly how to manage those short-term assets and liabilities to maintain that necessary level of liquidity.
And that distinction, profitability versus liquidity, that's really the conceptual starting point for this whole discussion, isn't it?
It is.
So if we find ourselves needing to plug these WCM gaps, maybe because our cash cycle is too slow or collections are poor, we often turn to short-term finance. What are the main ways we do that, and what's the structural risk we're taking on?
Typically, short-term finance involves leveraging an overdraft facility with a bank or effectively increasing our use of trade credit by just, delaying payments to our suppliers, which increases our payables.
Okay.
Now, there's a perception out there that short-term finance is cheaper or maybe easier than issuing long-term bonds or raising equity. And this perception is often, I have to say, deeply flawed.
How so?
Well, while getting an overdraft might be quick, the variable interest rates on them can be exceptionally high. Often, they're significantly higher than long-term commercial loans, and more subtly, delaying payments to suppliers. I mean, it seems free, right?
Right. It feels like free money.
It does, but it often means you're losing out on valuable prompt settlement discounts. And we will quantify this later, but trust me, they carry a surprisingly high implicit cost.
So we've got the explicit cost, the high overdraft interest, and then this hidden implicit cost of lost discounts. But the biggest danger, the one the examiner really wants you to focus on, that's the structural risk.
Precisely. The structural risk is paramount. Short-term finance, particularly an overdraft, is often repayable on demand.
On demand.
That is the key phrase. It's the key difference from a long-term loan structured over 5 or 10 years. If your bank suddenly loses confidence in your business's ability to manage its cash, Maybe there's an unexpected economic slowdown, or they read a worrying news report about your sector. They can call in that debt immediately.
And that could be catastrophic.
Imagine it. Your company is fundamentally healthy, but a large customer pays you a bit late, and you have payroll in 2 days. You're relying on a £5 million overdraft. If the bank, maybe facing its own pressures, decides to reduce its exposure and calls in that $5 million instantly, you face a liquidity crisis that could trigger insolvency within days.
Regardless of how good your long-term projects are.
Irrelevant. Your long-term assets and projects mean nothing in that moment. This fundamental structural risk of short-term, repayable on-demand finance is a high-mark analytical requirement for your written answers.
So the goal of WCM can't just be to minimize working capital, because doing that actually increases that structural risk. We're looking for a balance. A delicate balance. It's about making sure there's sufficient cash, enough liquidity for day-to-day operations, a safety buffer, but without tying up so much capital that it's just sitting there idle, earning nothing.
Exactly. That excess idle capital could be deployed into profit-earning investments, non-current assets, expansion, anything else.
And that's the core conflict.
Yeah, that is the core conflict. And this brings us right back to what the examiner expects. They are testing strategic insight. They are not satisfied with you just calculating a ratio and saying, oh, it's too low.
It's not enough.
Not nearly enough. If you recommend reducing inventory levels, a classic strategy to improve profitability, you must immediately explain the associated counterbalancing risk, the danger of production stoppages, potential lost sales because you've stocked out, damage to customer goodwill.
You have to show both sides of the coin.
Every single time. Similarly, if you suggest tightening credit control to reduce receivables, you must discuss the potential negative impact on your sales volume, on your market share, and on long-term customer relationships. The analytical marks are earned by showing you understand that every WCM decision is a complex choice between risk, profitability, and operational impact.
Okay, so let's dive into that core strategic trade-off then. Liquidity versus profitability.
This trade-off is the conceptual bedrock of working capital management. Honestly, if you don't grasp this conflict, you won't be able to provide any meaningful analysis in the exam.
So let's define that conflict. Maybe we could use two distinct WCM policies, one that favors safety and one that favors, say, efficiency.
Absolutely. A great way to think about it. So policy A, let's say, favors high liquidity. This is the conservative approach.
The safe bet.
The safe bet. The company holds more cash, maintains unnecessarily high inventory levels just in case, extends very generous credit to customers, and relies minimally on short-term debt. This drastically reduces the risk of running out of money, but cash sitting idle or excess inventory stockpiles, they're not earning significant returns, so the overall corporate profitability is suppressed.
Okay, that's the conservative approach. What about the other end of the spectrum?
Policy B favors high profitability. This is the aggressive approach. This company minimizes working capital components ruthlessly. They hold minimal safety stock. They are extremely aggressive in collecting receivables, and they maximize their use of payables credit and short-term debt.
So they're running lean.
Very lean. This maximizes the return on deployed capital. It's highly efficient, but it comes at the steep cost of maximizing liquidity risk. They operate too close to the edge, which makes them highly vulnerable to any unexpected events.
And this is why we have the headline ratios, right?
Yeah.
To give us a quick gauge of where a company sits on that aggressive to conservative spectrum, we're talking about the current ratio and the quick ratio.
Exactly. Starting with the current ratio, which is current assets divided by current liabilities. Conceptually, this tells us if the company has enough assets that are expected to convert to cash within a year to cover all its debts due within a year.
And the general rule of thumb.
Generally, you'd expect it to be greater than 1. If it's less than 1, that's a red flag, a strong indication of potential liquidity problems.
And then we have the quick ratio, or acid test, which gives us an even tougher, more immediate gauge of solvency.
Correct. The quick ratio is current assets minus inventory, all divided by current liabilities. We strip out inventory because traditionally it's the least liquid current asset. It needs production. If it's work in progress, then it needs to be sold. Then you need to collect the cash.
A lot of steps.
A lot of steps. The quick ratio tells us what immediate cash resources are available without having to rely on selling off existing stock.
Okay, and this is where the analysis comes in, because you can't just apply a standard benchmark, can you?
You absolutely cannot. This is where the analytical depth is required. Consider a high-volume supermarket chain. Their current ratio might be low, maybe 1.2. Their quick ratio might be 0.6. By the textbook, this looks dangerous.
It does.
However, their inventory milk, bread, fresh produce, it sells and converts into cash within days. Their working capital cycle is incredibly fast. For them, a low quick ratio is manageable because their inventory is practically cash.
Right. Now contrast that with, I don't know, a bespoke luxury yacht builder.
A perfect example. For the yacht builder, their current ratio might be a healthy-looking 2.5, but their quick ratio might only be 1.0. If their inventory is made up of highly specialized bespoke materials for a custom build that could take 2 years to complete, that inventory is highly illiquid. If a customer cancels an order, that inventory has very limited resale value. For this company, a quick ratio approaching 1.0 is still critical because that inventory takes a vast amount of time to monetize. The examiner expects you to interpret the ratio in the context of the business scenario provided.
Let's turn now to a concept that is absolutely crucial for the longer narrative-written questions. It links profitability directly to insolvency. I'm talking about the danger of extremely low liquidity, or overtrading, sometimes called undercapitalization.
Yes. Overtrading is the structural failure that occurs when a successful, usually high-growth company expands its sales and operations far faster than it can structurally finance its increased working capital needs. It is, and I mean this, the Achilles heel of success.
The paradox of growing too fast.
It is. Let's use a clear scenario. Imagine a software company that launches a viral product. Their sales double in 6 months. Fantastic news.
On the face of it, yes.
To meet this growth, they need a bigger office that's a non-current asset, more staff, and crucially, they need to extend credit terms to win large corporate clients. So a massive increase in receivables. They successfully raise, say, $10 million in long-term finance, but they invest $9 million of that straight into the new office and equipment.
So they bought the shiny new assets, but they've neglected the day-to-day requirement.
Precisely. They bought the beautiful house but forgot to buy any groceries. The remaining $1 million is completely insufficient to fund the exponentially increased level of inventory, the much larger receivables book, and the immediate operational expenses.
So what happens?
Well, their long-term assets look great. Their profit forecasts are huge. But because they neglected to allocate adequate permanent capital to the necessary base level of working capital, they are perpetually short of cash.
And they fall into that trap we mentioned earlier.
They fall into the spiral of relying heavily on short-term, repayable on-demand finance, the bank overdraft. And then when the next large customer delays payment by 30 days, a completely normal business event, the company hits its overdraft limit.
The dominoes start to fall.
They do. Suppliers, sensing trouble, reduce their credit terms and demand cash on delivery. And suddenly the company, though profitable on paper, cannot pay its immediate debts. This leads to insolvency. Overtrading is the classic case of profitable growth leading to bankruptcy.
It's a terrifying, but as you say, incredibly common real-world scenario. So for the exam, what is the conceptual solution to overtrading?
The solution is always structural. The company must raise additional long-term finance, and this finance isn't used to buy another factory. It's necessary to support the increased operational scale, to structurally finance that necessary permanent base level of working capital. This is essential to move away from the highly risky reliance on short-term debt. Demonstrating this understanding that WCM needs structural long-term funding is a powerful analytical point.
Okay, let's unpack the individual components then, starting with inventory. This is often the largest commitment of capital on the balance sheet, so it carries one of the highest holding costs. And to manage it efficiently, we rely on the logic of the economic order quantity, or EOQ.
The EOQ model provides a beautiful, simple core logic. It's about finding the optimal order size that minimizes the total annual cost related to managing your inventory. It's a trade-off model. It seeks to balance two opposing cost categories.
Okay, let's elaborate on those two forces. What are they?
First, we have the reorder cost. This includes all the fixed costs you incur every single time you place an order. So administrative processing, quality checking, the delivery transport fee itself.
Right.
Now, if you order a massive quantity once a year, you only incur this fixed reorder cost once. So ordering a larger quantity means fewer orders per year and a lower total annual reorder cost.
Okay, so that's pushing us to order in big batches.
Yeah.
What's the force pushing in the opposite direction?
That would be the inventory holding cost. This includes the physical costs like warehousing space rental, insurance, handling, security. It also includes the crucial risk of obsolescence or damage. But most importantly, for the FM calculation, it includes the interest cost or the opportunity cost of the money that's tied up in that inventory.
Right. The cash isn't earning a return.
Exactly. So if you order a large quantity, your average inventory level in the warehouse is higher throughout the year, which means your total annual holding cost increases.
So the EOQ is the mathematical sweet spot, the meeting point where the total of those two opposing costs is at its absolute minimum.
That's it.
And there's a key caveat for the EOQ calculation, isn't there? Something students sometimes miss. It involves the purchase cost itself.
Right. The simple EOQ calculation typically excludes the annual purchase cost, and that's because the company's total annual demand is constant regardless of how many times you order. However, the purchase cost becomes critically relevant if, and only if, the supplier offers quantity discounts for ordering in bulk.
And that's a popular exam calculation. So how does the financial manager approach that quantity discount decision in a practical way?
The decision structure is a mandatory requirement. First, you calculate the EOQ ignoring the discount. Use the basic formula. Next, you calculate the total annual cost at that EOQ level. And this cost now has three components: the total annual purchase cost, the total annual reorder cost, and the total annual holding cost.
Okay, so you have your baseline cost.
You have your baseline. Then you calculate the total annual cost when ordering the minimum quantity required to get the discount. You compare the two total costs. The savings you get from the reduced purchase price, the discount, must be substantial enough to outweigh the increase in holding and reorder costs that you incur by ordering that suboptimal larger quantity. It's a structured comparison.
Okay, so moving from that mathematical model to something more conceptual, a business philosophy, just-in-time or JIT. We stressed earlier this is more than just an ordering system.
That's a vital point. JIT is a comprehensive business philosophy focused on eliminating waste and inefficiency throughout the entire value chain. Its goal is to hold minimum inventories, finished goods, work in progress, and raw materials. This shift fundamentally affects procurement, production planning, and supplier relationships.
So for the exam, what are the key conditions you need for JIT to actually work?
You must be able to articulate the conditions for success across all the inventory types. For finished goods, success hinges on demanding production processes. It requires a rapid production period, often called demand pull, where production only starts when a customer order is received. And you need very accurate demand forecasting.
And what about for work in progress, the stuff on the factory floor?
For WIP, the key is minimizing the throughput time. That's the time it takes for a raw material to move through the factory and become a finished good. The faster the production process, the lower the average WIP level automatically becomes. And this requires highly flexible and skilled workers who can perform multiple tasks and quickly adapt production volumes at short notice.
And the reliance on external partners for raw materials. That's where the financial risk often concentrates, isn't it?
Absolutely. JIT for raw materials requires the company to receive materials from its suppliers only as they are needed for production. This completely eliminates the need for large warehouses.
Sounds efficient.
It is, but it demands meticulously selected suppliers who can deliver quickly, frequently, and with guaranteed quality. The critical financial and operational implication here is the intense reliance you place on those few suppliers.
Because you have no buffer.
You have zero buffer stock. So a late or faulty delivery shuts down the entire production line. This arrangement often requires drafting tight contracts, maybe even with severe penalty clauses, to enforce that reliability and quality standard.
But wait a minute. If you're relying so heavily on just one or two specialized suppliers under a tight contract, doesn't that massively increase your supply chain risk? What happens if there's a port strike, a geopolitical issue, a natural disaster that cuts off that single source?
That is precisely the analytical challenge the financial manager faces, and it is a key point the examiner looks for. JIT increases efficiency and reduces holding costs, but it exchanges those costs for a magnified risk of external disruption.
So what's the answer?
A financial manager implementing JIT must ensure they have robust contingency plans, perhaps alternative, albeit slightly more expensive, supply chains that can be activated immediately, or ensuring against large business interruption losses. The benefits of JIT, and there are many, must be weighed against this concentrated operational vulnerability.
And we should stress that the benefits of JIT go beyond just simple cost savings.
Indeed. While lower holding costs are significant, less warehousing, less insurance, less tied capital, the larger strategic benefits come from improved efficiency and quality. JIT forces better quality control because defects are immediately apparent. You can't hide them in a buffer of stock.
So it forces discipline.
It forces discipline. And this leads to less wastage, greater overall operational efficiency, and ultimately better customer satisfaction due to faster fulfillment and lower defect rates. It is a transformational philosophy, not just a system for ordering parts.
Okay, let's pivot now to receivables and payables. Managing the money flowing in and out of the business. Managing receivables, it really boils down to balancing the potential profitability from increased sales against the inherent risks and costs of extending credit.
That is the perfect summary. Extending credit, it acts as a marketing tool. It can boost your sales volume and your potential long-term profit. But the costs are significant. You have the risk of bad debt, the explicit administrative cost of running a sales ledger and a collection department, and the major cost of the capital that's tied up in that receivables period. The longer you wait to collect, the more expensive those assets become.
So when a company is considering offering credit to a new customer, especially on a large contract, what sort of rigorous assessment tools should the financial manager be using?
A standard credit control assessment is mandatory. It should involve using third-party resources like credit rating agencies to gauge financial stability and payment history. For new customers, getting trade references from their existing suppliers or bank references is essential to determine their reliability.
And for the big fish.
For significantly large contracts, the financial manager absolutely must analyze the customer's published financial statements, assess their solvency, their profitability, their capacity to pay, and finally, you need continuous internal monitoring of payment records and a strict review of credit limits for existing customers to prevent bad debt escalating.
We touched on quick settlement discounts earlier. If we offer a discount, say 2%, if they pay within 10 days, how does the financial manager quantify if that policy is economically rational?
This is a high-value analytical calculation in the FM exam because it demonstrates a clear understanding of opportunity cost. Offering a quick settlement discount, it reduces your average collection days. That benefits the company by reducing the amount of working capital tied up in receivables. And that reduction leads to an interest saving as you need less short-term borrowing.
But that saving comes at a cost.
It comes at the direct cost of the discount itself. You have to compare the net cost or benefit. If the annual interest saving on the accelerated cash flow is greater than the total cost of the discounts you've offered, then the policy is worthwhile.
Let's make that specific, because this is where the aha moment happens for a student. Imagine our terms are 210 net 30. So 2% discount if you pay in 10 days. Otherwise, the full amount is due in 30 days.
Okay. If the customer does not take that discount, they are, in effect, borrowing that 2% for the extra 20 days, from day 10 to day 30. And the implicit cost of this credit is enormous.
Now enormous.
Well, if you annualize that 2% cost over that 20-day period, assuming 365 days in a year, you calculate that the implicit annual cost of not taking that 2% discount is approximately 36.7%.
36.7%. That's huge.
It's huge. And the analytical insight for the financial manager is stark. If our company's cost of short-term borrowing, say our overdraft rate is only 12%, we're essentially telling our customers, don't pay us, take the 36.7% loan instead. The discount decision is fundamentally about optimizing our cash flow against that incredibly high implicit cost.
That puts the magnitude of that implicit cost into a very clear relief. Now, what about factoring? This is an increasingly common strategy. It's often framed as just outsourcing the headache, but it's more complex than that.
It is. Factoring is indeed the use of a third party, the factor to administer and potentially finance the receivables ledger. The service is offered very significantly, and you must understand the 3 distinct levels for the exam, as the fees and the risk profiles change dramatically.
So it's level 1.
The basic level is administrative only. The factor maintains the sales ledger, sends out invoices, and handles the debt collection process. This is essentially a specialized administrative service, freeing up your internal staff.
Okay, what's the next level up?
The next level is advance finance. The factor advances money, typically 70% or 80% of the invoice value, immediately upon invoicing. This significantly accelerates the company's cash inflow, drastically shortening the cash conversion cycle. It can free up capital that might have otherwise contributed to an over-trading situation.
And the top tier.
The highest fee, highest benefit option is non-recourse factoring. This is the key strategic difference. In this scenario, the factor accepts the responsibility for any bad debts. The company is effectively insured against customer non-payment.
So that's different from with recourse factoring.
Completely. With recourse factoring, the company retains the risk of bad debts, even if the factor does the collection. Non-recourse factoring transfers the credit risk entirely, and the factor must then rely on their own expertise to vet and collect from the customers.
Moving to the other side of the ledger, payables management. It's often labeled free finance. Why is that a myth, or at least dangerously misleading in a strategic context?
It's misleading because it ignores the opportunity cost. Trade credit is only truly free if you are receiving the best possible terms and are not losing a discount. The moment a supplier offers a prompt payment discount and you fail to take it, the cost of that lost discount, as we just calculated, is the actual implicit cost of the free credit you are taking. And that cost is usually cripplingly high.
So the analytical focus for payables isn't just about delaying payment for as long as possible, but about managing that payment period efficiently.
Precisely. The key analytical point is comparing the effective annual cost of not taking that settlement discount against the company's actual cost of short-term borrowing. If the implicit cost of the lost discount, that 36.7%, for example, is higher than the company's overdraft rate of 12%, then the financial manager should pay the supplier early.
Using the overdraft to save money.
Exactly. You use the cheaper 12% overdraft to secure the 36.7% saving. Ignoring that high implicit cost means the company is inefficiently managing its cheapest source of finance. Good payables management involves maximizing the credit period only up to the point where it becomes more expensive than other forms of short-term finance.
Okay, let's talk about managing the most liquid asset of all, then cash.
When we talk about cash, the most important WCM tool in practice, far exceeding the ratios, is undoubtedly the cash budget.
Why are cash budgets so central to WCM in the real world and therefore in the exam?
They are vital because they provide predictive power. A cash budget projects likely inflows and outflows over a future period. This allows the financial manager to identify likely deficits or surpluses in advance.
So you're not just reacting.
You're being proactive. This foresight allows for proactive action to be taken, preventing a crisis. Without a budget, you are simply reacting to shortfalls as they occur, which inevitably forces you into expensive, last-minute borrowing decisions.
Can you give me an example?
Sure. If the budget predicts a severe cash deficit in 3 months, maybe because of a large anticipated tax payment or a seasonal downturn, the manager has time. Time to arrange a pre-approved, favorable, short-term borrowing facility, or perhaps execute a non-critical asset sale.
Okay, so let's review the common actions for managing those anticipated cash positions. This shows that crucial practical awareness. What actions would address an anticipated deficit?
For anticipated deficits, the immediate steps focus on rapid cash generation or securing low-cost debt. So you're looking at using existing short-term borrowing like an overdraft, negotiating longer terms with suppliers if no discount is lost, accelerating collections from customers, selling surplus and non-core assets, or maybe even a sale and leaseback on a non-current asset to get immediate cash while retaining its use.
And if the budget projects a healthy but temporary short-term surplus, what do you do with that?
The priority is maximizing return while maintaining extreme liquidity and low risk. So actions would include immediately reducing any outstanding overdraft to save interest, investing the surplus in highly liquid, low-risk instruments like short-term treasury stock, placing funds in high-interest bank deposit accounts, or perhaps briefly holding small amounts in very stable blue-chip shares if the time frame is very short.
The key word there is temporary. What if the surplus is projected to be long-term?
A long-term surplus suggests structural overfunding or a lack of profitable reinvestment opportunities, and that demands a strategic response. So, funding new long-term projects, CapEx, acquiring other companies, initiating share buybacks, increasing dividends to shareholders, or strategically repaying long-term loans before they mature.
Okay, so beyond the cash budget, we need to touch conceptually on the models designed to optimize the physical cash holding levels. Let's start with the Baumol model.
The Baumol model is highly theoretical, but it provides crucial conceptual understanding. Just like we saw with EOQ, it operates by balancing two opposing costs. It gives a formula for the optimum amount of cash to transfer from an investment account, that's earning interest, to the transaction account where you make payments from each time.
And what are the two costs it's balancing?
It minimizes the transaction costs, that's the brokerage or administrative fee of selling an investment to get cash, and the opportunity cost, which is the interest you lose by holding cash in a low or zero interest transaction account instead of a higher earning investment account. It finds the balance between transacting too often, which gives you high transaction costs, and holding too much idle cash, which gives you a high loss interest cost.
And the Miller-Orr model is seen as the more realistic, flexible approach for dynamic business environments. How should we conceptualize that one?
The Miller-Orr model is more realistic because it accounts for the inevitable volatility of cash flows. Cash inflows and outflows, they fluctuate daily, so the cash balance wanders up and down randomly. Rather than fixing a single optimal point, it fixes an upper limit and a lower safety limit.
Like guardrails.
Exactly. You can think of it like a thermostat controlling the temperature of the cash account. The management task is simply to ensure the balance stays between these limits. If the balance hits the lower limit, the cash account is getting too cold, the manager transfers cash in from investments to reach the calculated return point, which is the desired operating temperature.
And if it gets too hot?
If it hits the upper limit, too hot, too much idle cash, the manager transfers the excess cash out to investments to bring it back down to that return point. This provides essential flexibility in a fluctuating environment and explicitly recognizes the need for safety buffer, that lower limit.
This brings us to the final, and I think the most critical piece of advice for the FM student preparing for the written questions. You're now armed with all these models and ratios, but what is the common student mistake, and what does the examiner really require to earn the highest marks?
The common student mistake is focusing only on the mechanisms. Defining EOQ, listing the 3 levels of factoring, calculating the current ratio. They provide data without diagnosis. They ignore the so what.
They're just describing, not analyzing.
Exactly. The examiner requires you to be analytical, practical, and integrative. You must be able to explain the business implications of WCM failures and the strategic impact of WCM decisions.
So you have to connect the dots.
You have to connect the dots. The key is synthesis. If a scenario presents a company with increasing sales but collapsing cash flow, the classic overtrading failure we discussed, the successful candidate must link it all together. Why is cash flow collapsing? Because credit terms were extended too generously, increasing receivables. Stock levels increased too fast, increasing inventory. And this was structurally undercapitalized, a failure of finance.
And the solution has to match the diagnosis.
The solution must then address all 3 components: the strategic need for long-term finance, the need to review the credit policy, and perhaps implementing JIT to minimize the cash tied up in stock. The ability to articulate this linkage, how policy decisions affect risk, liquidity, and long-term financing strategy, that is where the strategic marks are truly earned in the FM exam. WCM is not just a chapter, it's a strategic framework for survival.
That brings us to the end of this truly deep dive into the management of working capital. To quickly summarize, remember that working capital is a strategic area focused on operational survival. The liquidity versus profitability trade-off is central to every single decision you analyze. And understanding conceptual risks, particularly the structure and the structural solution of overtrading, is absolutely essential for succeeding in the narrative components of your exam.
And hold on to this final provocative thought. Sound financial management in the short term, WCM, is the constant fight for survival. It determines whether a company even survives long enough to realize the long-term profits from its huge CapEx decisions. If the cash conversion cycle stalls, the long-term vision dies. Never underestimate the critical, high-stakes nature of managing your daily cash flow.
This deep dive into WCM logic and examiner expectations was brought to you by SmartPass. To get full ACCA exam-focused podcasts and detailed explanations tailored for your syllabus, remember to subscribe to the SmartPass YouTube channel. And for daily exam tips, revision strategies, and updates designed to keep you focused and confident, follow the SmartPass Instagram page. You'll find the link right below this deep dive. We look forward to helping you master the next chapter of financial management.